statewide virtual program, 2020 Revision Texas M&A. I'm Pat Niekamp of the Austin San Antonio chapter, and I'll be your moderator for today's panel. If you have a question for our experts, look for that Q&A button down at the bottom of your screen, and we'll get to answer your questions later in the program. Here are the committee members who put this panel together. Our 3 Texas chapters work collaboratively to put together today's group of experts to handle logistics plus all of the details. Thank you all. Thanks also to the sponsors from each chapter who have continued to support ACG. We are grateful to the chapter sponsors from Austin, San Antonio, to the Dallas-Fort Worth Dealmaker Series sponsors, and finally, our chapter supporters from Houston. As you can see, we have a diverse, understanding, and supportive collection of sponsors across the state. Since we're talking about money and legal issues this morning, please recognize that the opinions of our panelists are just that, their opinions. We'll also be recording this panel and sharing what everybody had to say afterwards. Not only are we sharing information and answering your questions, we want to know what you see in the market. To do that, we'll be polling you. By the time we're done, you should have a clearer picture of where we are and what's likely to come in the world of Texas M&A. So let's get started. Our Texas business leaders are involved in just about every type of industry. For those with cash and creativity, it's likely to be an exciting time. For those without liquidity and ingenuity, the stakes have never been higher. As we continue through another cycle turn, what's in store? Let's find out. Our first panelist is San Antonio M&A attorney Will Liebman from the Dykema firm. Morning, Will. Can you start us off with what you see on the status of deals?
Absolutely. Thank you, Pat. Let me start by saying thank you to the committee that worked hard to put this event together. It's really nice to see all the ACG chapters across Texas working together to bring great content to all of our members. And what great attendance we have today. So to each of you, I say thank you for taking time out of your day to join us. Let me talk quickly about 3 issues that I'm seeing right now from a legal perspective. First are issues surrounding valuation. You know, there are 3 essential ingredients to any M&A transaction. First, you've got to have a buyer with sufficient capital. And for the most part, I don't think that's a problem today. Lots of private equity firms are sitting on lots of dry powder. And moreover, I think the Fed has done a good job so far in keeping our capital and credit markets working well. Second, you've got to have a willing seller. And that's also not a problem right now, I don't think. I mean, there are plenty of sellers in the market right now that want to sell. And in fact, the financial distress that's been brought on by the pandemic, I think has even increased the motivations for many to sell. Some now really have to sell. Finally, you need to have agreement on price. And I think that is where things are getting bogged down right now. We've all heard of EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. Is the most common financial metric used to help value businesses. But nowadays, I think most sellers would prefer to use a metric called EBITDAC, which is earnings before interest, taxes, depreciation, amortization, and COVID-19. Now, you might laugh, but the truth is that COVID's effect on valuations is still largely unknown. And that is slowing deals down or even bringing them to a grinding halt. Now, here's what I'm seeing. One deal that I was working on when the pandemic hit and the lockdown started that continued forward without delay was a transaction between 2 oil field service companies. And the reason why I think that deal continued without delay is first, the energy industry has been, beset with distress, not just from COVID, but also from overproduction in the Middle East and elsewhere. And quite simply, this was a deal that had to happen, and it had to happen fast. And second, it was a stock for stock transaction. So the risk that the buyer was overpaying was offset by the fact that the sellers were taking buyer stock as payment, and therefore they kept skin in the game and they would share in the downside risk if the buyer overpaid on the deal. And I think that deal was a good example of how we can move forward from here on deals that may be held up by valuation risks. Buyers and sellers are going to need to get creative on how to mitigate and share that risk through mechanisms like stock for stock mergers, earnouts, and the like. Now, the other thing I'm seeing from a legal perspective are issues surrounding deal certainty and deal protection. If you're a seller and you're signing up a deal that's going to get announced to your customers and your employees and your shareholders, you want there to be as much certainty as possible over whether the deal is going to close. But if you're the buyer, you want to be able to walk away from a deal or at least renegotiate it if something bad happens before closing. A big time recent example of how this can play out is the failed $525 million acquisition of L Brands. L Brands is the owner of Victoria's Secret by the private equity firm Sycamore Partners. Now, the agreement in that deal, which was to buy a controlling interest in L Brands, was negotiated and signed in late February, just before the pandemic hit. And deal lawyers hammered out a material adverse change provision that would have allowed Sycamore to walk the deal if L Brands suffered a material adverse change to its business. However, the lawyers for L Brands succeeded in excluding the pandemic from the definition of material adverse change. Lawyers for Sycamore, however, were successful in keeping a fairly common provision in the agreement that required L Brands to operate in the ordinary course of business until closing. So weeks later, the pandemic struck and Victoria's Secret closed all of its stores and furloughed most of its workforce. And Sycamore walked the deal. They contended that there was a breach of the agreement. Victoria's Secret responded, no, there wasn't a breach of the agreement. They were just responding to a public health emergency like every other retailer in the country. And that Sycamore, in fact, had agreed to bear the risk of the pandemic. But the Sycamore partner said, no, closing all your stores and firing all your workers is not ordinary course. And I think this would have been an absolutely fascinating case to see play out in the Delaware courts. But sadly for corporate lawyers like me, Sycamore and L Brands announced earlier this month that they had settled their dispute out of court. But Sycamore was reportedly not required to pay any breakup fee or termination fee when they walked. And I think this example shows just how important it is to give really serious thought about how to negotiate good deal protection measures. I'm sure the Victoria's Secret lawyers thought that they had really scored a major win in the negotiations when they succeeded in carving out the pandemic from the material adverse change provision. But I think in the end, Sycamore's lawyers appear to have had the last laugh because they were able to keep a common provision in the deal that ultimately allowed them to walk, and the deal didn't close. Last issue that I'm seeing are issues surrounding risk allocation. A big part of the M&A game involves the identification and assignment of risk. And this is largely done by the buyer conducting due diligence on the seller and then building in a comprehensive set of representations and warranties by the seller into the transaction agreement. And then backing up those reps and warranties with either an indemnity provision where the seller protects the purchaser from reps and warranties being false, or through acquiring a reps and warranties insurance policy. So if the buyer's damaged, they can either get part of the purchase price back from the seller, or they can make a claim under the reps and warranties policy to be made whole. What we're seeing right now is that many of these reps and warranty policies are coming in with broadly worded exclusions for the COVID-19 risks. And in turn, that's putting pressure on buyers to spend more time doing due diligence to identify all the ways that COVID might come back to haunt them after closing. Things like workplace safety issues, supply chain disruptions, litigation exposure, and so forth. And that's really gumming up the works and slowing things down. Lots of other things to talk about from the regulatory side of things and from distressed asset sale considerations, but I won't go into that now. I'll turn it back to you, Pat.
Thank you, Will. I probably up to this point had not heard the term material adverse change provision. I have a feeling that we are going to hear a lot about this by the time all of this is done. Will, thanks. Our second panelist is banker Michael Gardner. Michael is president of the Texas and Oklahoma region for UMB, and he is based in Fort Worth. Morning, Michael. What's happening in banking these days?
Morning, Pat, and thanks for having me. And I'll echo what Will said. Thank you, everybody, for joining this morning. You know, prior to the COVID-19 pandemic, the M&A market was extremely strong, and we saw the largest amount of activity in the space that we'd seen in decades. In addition, the high demand was creating a valuation gap. Purchase prices were at historic highs, with EBITDA multiples reaching over 10 times. High multiples meant two things. It was a seller's market, and the purchase price inflation had led to increasingly large airballs. And from our perspective, the financing process grows more complex when the airball is larger. And then came a global pandemic that changed everything. So now that we've looked briefly at banking before COVID, let's take a look at the banking landscape after COVID. As you all know, in early March, the world stopped. We quickly transitioned to a remote working environment and the economy halted. And as a reminder, that was only 2 months ago. Today, we continue to face that extreme uncertainty. And it's still too early to tell what the future will look like. But if you're working on a deal right now, there are some things to keep in mind. And let me share some brief insights from a recent deal to show you what the current landscape looks like. We recently completed a deal that started in the January-February timeframe, the pre-COVID timeframe, working with a PE group who was acquiring a distribution company. We did more due diligence than normal given the current economy and the COVID effect that hit their business. And really, we asked all the right questions and determined with the PE group that, a little bit more equity in the deal to right-size the balance sheet was the right way to move forward. The bank still went through with the loan, and we closed in the April post-COVID timeframe. So all this to say that activity is still happening, just at a much slower pace. People are being more diligent than ever as we review the COVID impact and the effects it's having on the economy and businesses, especially in the M&A market. Prior to the pandemic, you could look at historical trends, you could make projections and have more certainty in those forecasts for companies you were looking to acquire. That's not the case anymore, as COVID-19 has impacted every business differently, and the full scope of that impact by industry and individual business hasn't been recognized yet. To combat that, people are looking at the COVID effect on every aspect of a business's operations, their buying power, their accounts receivables and payables, budget and revenue forecasting, and most importantly, the personnel and benefits. Here are some strategies I think you can put into place to make sure your deals continue to move forward, even if it's slower than you may have expected. First, take your time. In many cases, issues surrounding M&A deals typically arise from moving too quickly. Sometimes a deal requires a quick turnaround, but it's critical to carefully consider each element of the transaction. Signing the contract before securing financing, discussing financing with the other party before you're talking to your lender, or failing to assemble a team of key players early enough in the process can make the transaction more complicated, or it could completely fall apart. Secondly, perform your due diligence. From a financial perspective, failing to stress test the deal to account for unforeseen losses and performance decline is a major problem and can lead to the deal collapsing or unexpected issues at closing, especially now. Completing a careful analysis and forecast can help ensure this deal works now and into the future. Next, consider the people involved. Getting the numbers and details right is critical to a successful deal, but it's equally important to think about the impact of the merger on company culture, employee retention, and client relationships. Failure to consider these people-driven risk can leave you with client attrition and unexpected holes in your leadership team. And as we enter this virtual world, it's crucial to build these relationships with your clients and employees to address these cultural concerns. And lastly, finding the right partners. With so many factors impacting M&A deals, the job of a lender goes beyond financing a transaction. Before we ever determine a financing structure, our focus is serving as an advisor and ensuring our clients have considered all the logistics, implications, and potential costs of the deal prior to entering a contract. Buyers and sellers can still execute an effective M&A process even in today's climate. My overall perspective on the market right now, I would say cash is still king. For those who have it, we'll continue to seek out opportunities during COVID-19. Relationships are still important, and I would argue they're more important than ever. The new normal will most certainly be different. We're not having lunches and dinners with clients and prospects, and come June, we probably won't be doing that either. Our interactions will most likely continue to be virtual, and we're evaluating how we will do business in a virtual world when we're all in the people business. And what I'm seeing and experiencing, which is quite interesting, is that people are picking up the phone more than ever and really talking through a deal and not relying so much on email and text. So while we're seeing the M&A market slow down right now after years of increased activity, that will change as the economy slowly starts to improve. As this happens, companies that are built to capitalize in this kind of situation will start doing so. And as this happens, you'll see several changes in M&A deals, including increased and more detailed due diligence process to better understand how the COVID effect has affected their business at hand, longer regulatory approvals at the government level, changes to M&A agreements, including material adverse effect clauses, valuations, operating covenants, and closing conditions. And lastly, you're going to see extended timelines for consideration and closing. The bottom line is that fundamentals of banking haven't changed. We're just going through the due diligence process more thoroughly and differently than before. And I think the most important message I can leave you today is to do your due diligence. Make sure you understand all the risks of the transaction as the world is experiencing a new normal. And with that, I'll turn it back to you, Pat.
Michael, thank you. As you were talking, I was taking notes, and it occurred to me as you went through your bullet points of take your time, due diligence, do that stress test, issues relating to your people, the impact on culture, the relationships with your clients, and finding the right partners. This is good advice no matter what the environment. Today, it is critically important, but this is just plain good advice all along the way. Michael, thank you so much. Our final panelist is Houston-based Jeff Eaton of Eaton Partners. Eaton Partners is a capital placement agent and fund advisory firm. Morning, Jeff. Can you give us an update on what you're seeing in deal funding?
Sure, Pat, and thank you everybody for participating today. I guess I'm going to start with a couple words about us because I realize our business is a little bit perhaps more niche-y than Will and Michael's. But in short, we're at the tip of the spear for private capital fundraising. So we're not in the weeds on deal activity like Will and Michael are. We're at the top. We're raising money for some of the leading asset management firms in the world. Most of those are private equity sponsors, and we're raising that money from the leading institutional investors. So I like to think, what we're seeing in the private capital markets fundraising environment will ultimately be a good leading indicator of deal activity several months down the road. A little background on us. We, typical client of ours is, as I mentioned, leading asset managers. So think of some of the big private equity firms. We also do a lot of fundraising for first-time funds. So those are our clients, and we're raising money for them from the world's institutional investors. So in Texas, think of groups like Texas Teachers and UTIMCO. At any one time, we're in the market with 15 to 20 unique engagements, again, most of which are private equity funds. I think in terms of what we're seeing, this slide says it all, quite frankly. What we've shown here is, the typical lag of fundraising behind public market performance. There's no doubt been a downturn in the public capital markets. This black line could be slightly higher today, given the fact that we've had a little bit of a bounce back. But historically speaking, when we see that kind of market volatility, we have a pretty significant drop off in fundraising. So we expect to see fundraising, even in the face of being able to continue to do physical meetings, fall off. But obviously, when we combine market volatility with increased travel restrictions, the inability to do physical meetings, we expect 2020, and it probably lingers into 2021 also, fundraising activity significantly lower. The next slide sort of highlights some of the ramifications for this. These are pretty obvious points, but I think in short, we're going to see a decreased supply of capital flowing to private fundraising, yet we're going to see increased supply of managers seeking capital. So we've got a lot of managers that are sort of saying, let's write off 2020, let's load up and come back to market in 2021. When you combine that with the fact that 2021 was already going to be a pretty crowded market, we anticipate it to be pretty competitive for people to raise money. The next slide, I think, highlights some results of a survey we put out. I think there's some, you could look at this glass half full, glass half empty. Glass half empty, there's no doubt been an impact to fundraising as a result of coronavirus. There's a typical expression in our world, no meeting, no money. It's very rare for an institutional investor, again, think of a UTIMCO or a Texas Teachers, to write $100, $250 million check to a management team they've never met. So the inability for us to take our clients to do physical meetings is really having an impact. I think the glass half full view here would be that we don't expect this impact to last very long. If we go to the next slide, again, this is a reason that I'm optimistic. I think the short of it is, coming out of the global financial crisis, we saw investors basically turn it off and not commit money for several years. In the case of some endowments, they basically stopped investing, period, for a couple years. They learned the hard way, when you do that, you miss out on some great opportunities for investment. So I think what I'm encouraged by is we're seeing investors want to remain active. While allocations are down, they're not down nearly as much as you thought they would be. While they're putting money to work slower, they're still putting money to work, and they need to remain active, and they know it. I think another thing that's been pretty interesting, Pat asked us to talk about some anecdotes. I mentioned before, we have a typical saying of no meeting, no money. We've actually closed 4 commitments totaling about $300 million since the start of coronavirus for clients from investors when they never met. That's something we've never seen before. I think what it tells us is that investors are adapting to this new normal. They're using Zoom. We're doing on-site or 5-hour due diligence sessions, interactive, using Zoom. We've actually also secured some 3D cameras that we're doing interactive site visits and factory tours with, and we're seeing investors, some investors at least, get comfortable with doing that. In terms of the next slide, highlights where we see our continued interest. This is not comprehensive, but this sort of outlines where there is interest. Unfortunately, for Texas, there's literally no bid for most oil and gas strategies right now. In any given time, we're in the market with 3 to 4 energy funds. We're still having some success, but it is very challenging. The flip side of that is we're in the market with 2 other Texas-based funds that are non-energy focused, and we're seeing a lot of success raising money for them. Those happen to be buyout funds, one of them which has an industrial focus, and the other one has some exposure to healthcare, which are 2 areas that we still see some interest. So I guess overall takeaways from me, definitely a challenging environment, yet we see reasons to be optimistic. And we do think as we come out of this, we're going to have some pent-up demand for alternative investments.
Jeff, I thank you very much. Very comprehensive and great insights, especially on your graphs and charts. My thanks to your marketing guys for getting all that put together for us. Before we chat with our panelists and go to some questions and take your questions, I would like to ask that we release our first poll. We want to get everybody's thoughts on what's going on out there in your world. So in our first poll, we have 3 questions. If you haven't done this before, let me kind of walk you through it. So which of these issues concerns you the most? And you have several choices. Is anybody buying? Is anybody selling? Are deals closing? Changing valuations and multiples, or your ability to find funding? Our second question, how confident are you in the federal government's ability to manage the impact of COVID-19? You have 4 choices on that one. And finally, our third question, how confident are you in the state of Texas' ability to manage the impact of COVID-19? So we right now have 254 people online, and you are answering rather quickly. The polling is dropping in. And so our most pressing question, Will, the first item you started with on your presentation, changing valuations and multiples. This seems to be the greatest issue of concern here in Texas. And as far as confidence in the federal government, right now, 44% are saying somewhat confident, although not too far behind, somewhat unconfident at 32%. And our last question, how confident are you in the state of Texas's ability to manage the impact of COVID-19? And the answer is 54%. Well, God bless Texas, as we all know. God bless the Republic. We have much more support for our statewide government than we do for our federal government when it comes to it. All right, thank you all. We will have in a few minutes another poll. We will be asking you some more questions so you get a second sense of what's going on around the state. So let's get to our questions. First question, this goes to all 3 of you. How eager are investors to do deals and who is active? Jeff, I'm going to kick this one to you first.
Sure. So we'll start with what I know, which are the institutional investors. And as I was just mentioning, we still see them, they want to be active. I think they're picking their spots more wisely. The bar's higher than ever. But as I mentioned earlier, they still want to put money to work. Their focus seems to be primarily on strategies that are seeking to take advantage of the dislocation. So there are a number of strategies that would fit the bill there, but think distressed debt for control, think uncorrelated strategies. For instance, we've seen a lot of interest in music royalties, which is something, we've never really raised money for before. Data centers, things like that, where there's a sense that these are uncorrelated to the pandemic and uncorrelated to the financial markets seem to have the largest bid right now, Pat.
So just out of pure curiosity, why music royalties? What's cooking?
I think one, historically, there hasn't been a lot of access to it. So, it's typically been a space that has been invested in by a limited universe of investors, probably partly because they weren't very educated as to the attractiveness of it. But again, these are largely uncorrelated. So think about it. People are going to still listen to music, right? Even in an environment like this. They're structured similar to a minerals royalty where you basically have a share of any revenue. So we raised money for a client that had The Who, for instance, is one of the artists that it owned a royalty in. And you think every time you see a commercial where you hear a Who song, who are you or whatever, there's $1 or there's a percentage of that revenue going to the music royalty owners. So that's part of the reason, Pat. I think in short, largely because it's uncorrelated to the broader markets and thus viewed as a safer, more constant investment return.
That's interesting. Michael, I'm going to ask you next. How eager are you seeing investors doing deals through the banking lens?
Activity is still happening. We're seeing opportunities coming in and people are still interested in finding opportunities. As I stated earlier, valuations are changing, and so that's going to have an impact. But banks are still open and the fundamentals haven't changed. The due diligence process will ultimately take a little bit longer because of the COVID effect, but we're seeing activities happen and cash is still king. And so folks with that will seek those opportunities.
Absolutely. Will, who are you seeing as active?
Yeah. Well, obviously there's a healthy amount of activity out there. Like we've been saying, I echo what Jeff and Michael have said. Private equity firms are, of course, obvious source of activity, but let's not count out strategic buyers either. That's what I'm starting to see some of as well. I was talking to a client just last week, CEO of a fast-growing technology company that succeeded in raising a significant round of equity funding just in the last few weeks that he intends to put right to work in pursuing an M&A growth strategy for his business, really expanding market share and taking advantage of buying opportunities. I had another client last week that was approached with an unsolicited offer to buy a resort hotel property. Again, by a strategic buyer who's looking for ways to achieve operational synergies and isn't really deterred by what they consider to be a temporary disruption in the travel and leisure industry. So there are definitely things happening, and I wouldn't count out strategic buyers either, because they may be better suited to come in and actually evaluate the operational risks in doing their due diligence, more so than, say, a financial buyer that isn't already in the business. They may be able to better assess how the business is going to be impacted and the COVID effects that are going to be experienced. That's what I'm seeing.
Thank you, Will. Jeff, let me go back to you for a second. Can you spread this out just a little bit more, give us a little more insight on the strategies investors are most interested in?
Sure. I guess first I'll say that if you're a best-in-class manager in any strategy, meaning if you're an outperformer, and investors have all sorts of information available to themselves today where they can see relative performance of a manager versus others. But if you're an outperformer, you're probably going to still be able to raise money no matter what strategy you're focused on. So even in the energy patch, the best performing managers are going to be able to raise money. The challenged ones are the ones who have performed marginally. In a world, let's just take energy, for example, where there's decreased demand for the asset class, only the best will survive. Maybe there's a little bit of opportunity for someone doing something new. So there is an elevated curiosity, at least in distress for control in the energy patch right now. But if you're a marginal performer, you're not going to succeed. But if you look at the strategies in general, Pat, as I was saying earlier, uncorrelated strategies, I mentioned music royalties, data centers. That's something that people seem to be interested in. There's an increased demand for data, obviously. Infrastructure, non-energy infrastructure, I should highlight. For instance, water infrastructure seems to be of interest. And we're seeing an elevated interest in food and agriculture focused strategies as well.
Jeff, thank you. Michael, lending, what else are you seeing in the market these days? Give us a little more detail.
It's really too early to tell on what's going to happen, Pat. We're just seeing, I think it's been said here, strategic buyers and private equity groups who have the capital to go out and acquire a business. And because of where multiples are at and where valuations are going, those are going to be the ones. It's a broad market. We're more of a generalist. We don't go necessarily into verticals specifically on every kind of deal. So I think by and large, there's just plenty of opportunities out there with folks with capital.
Yes, there is. As I said at the very beginning, if you can pivot, if you have strong people, the opportunities become endless when there is cash available to you. We saw some great deals at the end of the 8, 9, and 10 window. And I think the same thing is going to come as we head into 2021. Jeff, I like what you said earlier about let's wipe off 2020 and let's focus down the road into 2021. I think it's true. We have a second poll up. I'd like to ask to open up the second poll. And we again have 3 questions. Let's see what Texans have to say about these issues. First question, how long do you think business disruption is going to last? 3 to 6, 6 to 9 months, or a year? Do you think the recovery is going to be a U, a V, or a W? And does your company qualify for federal COVID-19 assistance? And finally, has the coronavirus pandemic had a dramatic impact on your ability to work? While everybody's answering, Michael, let me ask you a question. I read in this morning's paper, nobody is stepping up looking for any of that federal loan money. Why do you think that is?
Sorry, I was on mute. Repeat the question, Pat. I don't know if I fully understand what you're asking.
Sure. This morning's paper had an article that the money that was approved by Congress that is available for loans, that nobody seems to be taking advantage of it. Why do you think that is?
That's a great question, Pat. The PPP loan process was very successful in round 1 and round 2 is still ongoing. A lot of banks, including UMB, really work to assist their customers and, you get through these times that we're facing now. So I think I would disagree a little bit, but I think a lot of the money people are using, and I know the programs are still rolling out and guidance is still coming. So I think the capital that was put out there was being used.
Okay. All right. So let's see what you all had to say. How long do you think business disruption is going to last? 6 to 9 months, which would cross us into early 2021. Do you think the recovery is going to be a U, V, or W? And 52% of our folks believe it's going to be a U. So we're going to go down and we're going to come back out. And then our third question, does your company qualify for federal COVID-19 assistance? The majority, 59%, say no. Has the coronavirus pandemic had a dramatic impact on your ability to work? In that one, 38% are saying yes, but 62% are saying no. All right, pretty good insights. We are beginning to get some of the Q&A from our folks, and I'd like to grab a couple of those questions, and then I have a few more questions for our panelists. So let's see what we've got here, folks. Let's get this out of the way, and up we come. Will, this might be one for you. Jeff, this might be one for you. In fact, all three of you. Health plan compliance is a big liability. What kinds of issues do you see with the employee benefits health plan packages?
You want me to go to first, Pat?
Yes, please.
Yeah, this is Will. I agree with you. It is a huge liability. And with everything going on in the workplace right now with reductions in force and furloughs and layoffs taking place. What happens to health plans and what rights do, terminated employees have in the face of all this? Super important. I would say again, in answer to that question, and of course, not being an ERISA law or employee benefits specialist, take your time, bring in the right expertise to identify problems and challenges. There's the status quo is not prevailing in this area. The Department of Labor, I am aware, has implemented some disaster measures. Deadlines have been relaxed, both for the companies in terms of meeting compliance obligations and burdens. They have a little more time to get reports out, to communicate with the employees, but at the same time, employees have been afforded more time to make claims and react to changing circumstances. So the government has said, look, we're going to slow things down also and give people more time to react to this. And so, whereas before you might have been comfortable with, okay, a deadline has passed, we don't have anything to worry about. The goalposts have been moved, at least temporarily, and you need to get good advice on how to manage that liability and that compliance burden.
Jeff or Michael, any more insights from either of you?
Not really from me, Pat. I thought you hit it pretty well.
All right, Will.
Same here.
Yep, thank you so very much. Michael, let me ask you a question next. Up until this point, buyers and sellers, let's say January and early February, everybody got along just fine. Market is strong. Now what happens? Deals are done. Are things going to get real chilly as the Q2 financials come out? What do you think?
No, I don't see that as being a widespread issue. We've been talking regularly with our clients, so there shouldn't be any real surprises when the Q2 financials come out. And if there are any of those issues, we'll take them on a case-by-case basis, as each business and loan is unique. So really, it's working with your customers with their issues, because they're all different based on industry and business. And I think communication is key. So I don't see that.
All right. I'm going to grab another question from our listeners. Jeff, this one is for you. Are PEGs, price earnings growth, going back to limited partners for further support of their stressed portfolios? If so, and if there is so much dry powder, why not invest their existing cash in their existing portfolios?
Sure, and I think, Pat, in our world, PEG has a slightly different acronym. I think it's private equity groups is what I think he's asking here. So good question. And I would say a lot of them are. I think some LPs, however, are concerned that a lot of these sponsors have already sort of lit some money on fire. And do they really want their private equity groups, putting more money into already troubled companies? So I think while it's something that some portfolio or private equity groups are able to do successfully right now, there is some concern amongst LPs that they really want to know these are viable companies and they're not just, throwing money away. I think the other thing to point out is oftentimes there's concentration limits. No one company can be more than a certain percentage of a given fund. And if they go beyond that, they have to go to the investors and ask for what's called co-investment. And that is when an LP has the discretion to say, yes, I want to fund more there, or no, I don't. So in other words, the private equity group no longer has all that discretion. And quite frankly, there's some LPs who are constrained right now. And part of that is tied to the previous question on the Q2 marks. I mean, right now, one of the challenges for the private equity industry is that the marks, there's a lag. So Q2 marks, or Q1 marks, I should say, probably don't come out, are probably coming out right around now. Yet we've seen this sell-off in the public markets. So what's called a denominator effect, if you look at someone's overall portfolio, the vast majority of one's portfolio are the public markets. That's down. So the largest slice is down, yet the private equity slice has remained inflated because it hasn't caught up yet. So I think we're actually going to see some positive stuff happen as those marks come down, because LPs are going to be once again under allocated to private equity, and they're thus going to have to put more money to work. But right now, as it stands right now, they look like they're over allocated based on that lag to the marks.
Jeff, I thank you. Michael, question for you. I've seen many banks pull back from cash flow based lending. The focus seems to be more on ABLs. I'm guessing that's asset-based lending. Are you seeing a similar trend? And how much more time do you need for your underwriting process? You said take things slowly.
Right. It's still too early to tell. I mean, it's a great question. As we enter what this crisis has we've seen from, but a position of strength with, capital and liquidity will be what's going to help to go long term. I don't have a lot of answers because it is so early to tell what's going to happen, and our banks pulling out. I can't speak for our competitors. I know, we're out still lending money to businesses right now, and we're using the same high quality underwriting and credit standards we've always used. So I would say, continue to have those conversations with your bank, and you'll see about how you can move forward in the next steps.
All right, and are debt multiples dropping? Our next question. Jeff, what do you think? Debt multiples dropping?
Well, I'm less in the weeds on the individual deals, but I will tell you that we are seeing an elevated interest from some of the smartest investors on debt-focused strategies that are seeking to buy the debt instead of the equity. Sometimes, with the feeling that the debt's trading so cheap, the intrinsic value, there's an intrinsic arbitrage there. But in other times, to go out and take control of the company with the view that, we can buy the debt cheap. Ultimately, it's going to become equity. So I don't know if I'm answering your question, Pat, but I think the activity of some of these smarter investors with an elevated interest in debt-focused strategies implies to me, at least, that they're seeing value, which implies multiples coming down.
Excellent. Yes, I think you have answered the question in quite well. Michael or Will, anything to add? Will, let me ask you a question. Purchase agreement details. We have not covered that, but I want to touch on it for just a minute. What can we expect to see for those who do own businesses on earnouts and seller notes?
Good question, Pat. Yeah, thank you. There's no easy answers on that. As I mentioned earlier, I think dealing with valuation issues and a buyer's concerns about overpayment is a major factor in the M&A slowdown we're seeing right now. I mentioned stock for stock deals and earnouts earlier. Stock for stock deals are a great way of addressing this, but they're obviously not for everyone. They work best for public companies who have liquid stock, easy to value in the marketplace. They don't work as well for private companies. Earnouts are nothing new, and they are a tried and true way of bridging gaps between a buyer and a seller over valuation. But here's the problem. Historically, an earnout was structured so that a portion of the purchase price was held back and then paid upon the target company's achievement of certain objectives like maintaining or increasing sales or profitability. And wary sellers would also frequently negotiate covenants in an earnout to require the buyer to take action to maximize earnout payments even, or at least continue to operate in the ordinary course to guard against the buyer either intentionally or unintentionally driving the company off a cliff and undermining the potential earnout for the seller. You could see, though, that model doesn't work as well now in the face of a widespread economic slowdown. And in some industries, the risk of continued or renewed shutdowns and social distancing and the like, especially if we have kind of a second wave of the pandemic. So just like we saw, in the Victoria's Secret case I talked about, how can anyone right now promise to operate in the ordinary course of business? And I think this situation is a major weakness in earnouts, at least the way they've historically been structured. One solution might be to tailor earnout metrics to something that is not so susceptible to market forces like a broad economic decline. So parties might consider metrics that measure things like market share or new customers or customer retention or brand loyalty, things that try to measure the quality and long-term value of the business, even in a down market. The solution may also just lie in doing, again, more and better due diligence upfront into whether and how the pandemic will affect a particular seller's business, and then spending the time to come up with a better financial model to account for those effects, and spending the additional time to get the buyer and the seller on the same page with respect to the valuation on the front end, instead of just kicking the can down the road using an earnout, which is really what an earnout is. It's just punting on the question and letting time sort it out. It's going to take more time and more trust to accomplish that, but I think that is the way things are headed.
Will, that is a perfect segue into our next question, which is, how is COVID valuation risk best mitigated to get buyers and sellers' valuations to intersect? Who wants to take that one?
Well, I'll jump back in just for a second to say, I think that, some of those points that I just made, find ways where there's some common ground to agree. And we've always been so focused on things like, EBITDA multiples and things like that. And those are so volatile right now and unknown. But I think there are other ways to look at value of a business over the longer term. And so I think we're going to have to get creative on finding some other metrics that might work in this environment to measure value and try to find that common ground. Michael,
any thoughts to add?
I think Will covered it pretty well.
Okay. Michael, I have a question for you. What percentage of your clients do you think could break the Q2 covenants and will either need loan amendments or additional junior debt of equity capital? Thoughts?
That's a great question. And I really would say it's too early to tell. As we're working with our customers, there's a lag in getting financial statements every month as they prepare those reports. I'm sure there's going to be some that have it, but to give you a specific percentage would be hard to say right now. We'll work with those folks as they come in and be communicative with them and try to help them with their businesses as they move forward. But it's still too early to tell what that will or won't look like.
And I have one more question for you. It seems banks have become tighter in limiting access to previous LOCs. Why?
I can't speak for our competitors. Everybody does things a little bit differently. The fundamentals, as I mentioned earlier, haven't changed. Every bank looks at things a little bit differently, and we look at all of our customers on a case-by-case basis because every need in every industry is different. So I can't say on why banks are doing that. If you have a loan agreement in place and you're following what that looks like, you should be able to move forward in a normal course of business.
Okay. Question to all panelists. What's your estimate on the percentage drop you have seen in deals closing on time post-COVID?
I can take a first shot at that, and I'm talking about fundraising closings, Pat. But
Yeah,
we've had several funds have closings since COVID started, which is obviously very encouraging. Again, getting back to what I said earlier, no meeting, no money. I'd say most of those, however, were funds we had in the market for some time, so LPs had already been able to do their diligence and do work. But for every fund that's had a closing, unfortunately, we've had an equal amount of funds whose closings have slipped. So I'd say, statistically, maybe not relevant because the sample size is small, but we've had 3 funds whose scheduled closings slip back a minimum of 3 months. And we anticipate, some more slippage. And that's really just a byproduct of, again, the bar being higher, investors still trying to make sense of all this, needing to know what is their allocation, needing again to see those new marks come out so they have an idea of whether they've got a larger or smaller allocation to alternatives. And then on top of that, the inability to conduct due diligence is challenging. So a lot of investors are sort of saying, hey, we're still interested, but we can't close now. We need some more time. We need to see how this shakes out. And quite frankly, we probably need to come visit you before we write this check. So I think, unfortunately, we do see an impact and we see things slipping.
okay. Michael, any insights from the banking side? How long is it going to take?
I think, as I said earlier, due diligence is going a little bit longer because everybody's trying to understand the COVID effect. And so that is having an impact on closings, but we're still seeing deals get closed. And so while it may take a little bit longer and there's some more questions and modeling that we're asking for and other banks are going to want to see, we're still seeing the deals get done. It's just, I don't have a percentage, but yes, they are slowing down just a little bit.
Will, any insight from your view?
Yeah, I've kind of been sitting here doing some math in my head, but I'd have to say in terms of, what percentage of deals are not delayed, it's a pretty small percentage. I would say the vast majority of deals are delayed by some extent. I agree with Michael that they're still happening. They're just happening slower. I would previously have told a client on a complex M&A deal, maybe 90, 120 days would be a good rule of thumb. I think you need to add another, 30 to 45, 60 days to that now as people sort out the uncertainties.
Okay. What's everybody's feeling on what's going to happen as we head into the fall? Is there any caution around deals or any provisions being made in agreement language about a second wave? Have we seen anything?
Well, I think it's a good question, Pat. I think one of the things that the science tells us is these pandemics do come in kind of second waves, even third waves. And so when we've been talking earlier about due diligence, particularly operational due diligence, learning about the target company and how it does business and how it has been impacted by the first wave, I think will be a good indication of what we could expect in a second or third wave. Is the workforce protected? Can they work from home? Can they work with, social distancing guidelines? Are they able to follow all the CDC guidelines? Are they susceptible to supply chain disruptions and all that? Those are all the sorts of questions that need to be asked about, what's going to happen in the second wave, because it will come. I think it will come.
Yeah, and Pat, from my perspective, again, less deal specific, but we're preparing for the ramifications of this to last a long time. And what I mean by that is, the new normal in terms of business travel, people who are they going to be willing to get on a plane and go to China to underwrite a fund that they're looking at? I mean, I think the short answer is probably unlikely for any time soon until there's herd. What's the term, herd cures or vaccines. So, I mean, I know for us, like, we're preparing for the ramifications of this to last a while. Again, the glass half full view is that investors have to remain active. So we think we hope they're going to adapt. We hope they're going to leverage technology more, get more comfortable with virtual on-sites, maybe, bending the rules about having to do a physical meeting. But we're preparing for this to sort of be a new normal. That's sort of showing itself in us demanding that all of our clients now have virtual presentations. They use video conferencing instead of audio conferencing, et cetera, because we're preparing for this to last a while.
Okay. We have a very specific investment question here. In view of COVID, would IT infrastructure and services be a good investment opportunity? Question mark. And especially to roll up a number of service providers and equipment distributors. Jeff, would your folks put money in that?
I would say this is one of the, data infrastructure at a high level is one of the hottest strategies that we've been working with right now. So our quickest fundraise this year was a data center fund, and we're actively looking for more IT infrastructure plays. So my short answer is yes, this is a strategy that is very attractive to investors right now.
All right, we are getting close to the end here. A final question for all three of our panelists. Please tell me, what will the M&A market look like in May of 2021? Jeff, please start.
Well, again, from a fundraising perspective, I do think we'll see increased activities. There's going to be some pent-up demand as a result of people, like I'm talking about, being challenged to put money to work when they still need to be making their allocations work. So I'm optimistic. I think 2021 should be a pretty good year from a fundraising perspective, and typically that shows itself in the form of elevated M&A activity from those sponsors as well.
Michael, how about for you?
I think you're still going to see deals happening from the banking side. You're going to see the due diligence will continue forward, as we've been talking about. Continued due diligence, the stress testing of the business will be so important to make sure they can get through these trying times. And I think you'll find a lot of businesses that will adapt to the current opportunities and being nimble and flexible within their existing business and opportunities that they have in the market.
And Will, it's May 2021. From a legal perspective, please share what you're seeing.
Wishful thinking maybe on my part, but I think in May of 2021, the M&A market is going to be fairly diverse and robust across multiple industries. I think the market will have successfully normalized expectations, and we won't be as paralyzed as we are right now over valuation issues. I think there will still be willing buyers and willing sellers out there, and things will start moving again. Legal documents will rapidly adapt to reflect the new risks that we're dealing with and appropriately allocate those risks between buyer and seller. I think it'd be more common to worry about issues that we haven't had to worry about for a while. Things like how to preserve and maximize the value of tax assets, like net operating loss carrybacks and carry forwards. NOLs were not given much thought in most pre-COVID deals. They were kind of phased out with some tax reforms, but provisions of the CARES Act recently adopted in the wake of the pandemic have breathed new life into NOLs. And certainly with businesses suffering right now, I think it's fair to say there will be a lot more NOLs to actually deal with in the near future. So in 12 months, we'll also have the second and third order effects of the pandemic understood, at least, and we'll probably find ourselves working through a wave of distressed asset sales, bankruptcy sales. I think firms that are well positioned to help with restructurings and bankruptcies are probably going to be very busy next year.
I would say. So let's wrap this up. I want to offer a thank you to our panelists, Will Liebman, Michael Garner, Jeff Eaton. We appreciate each of you sharing your thoughts, your opinions, and your expertise. Thank you also to our chapter sponsors and to the planning committee. We will be sharing the recording and the data. If you registered for this event, you will get the link. ACG Global has a great benefit for those of you who are members. They will be hosting their first ever virtual member summit. Mark your calendar for June 23 through 25. It is members only, so if your membership has lapsed, now is the time to rejoin. On behalf of Will, Michael, and Jeff, I'm Pat Niekamp. Have a great day.